This investor bought a property thinking he'd make a quick $96,000, but it turns out he couldn't even break even. And this guy owns over 100 properties, so this can happen to anyone. Which is exactly why you need to learn how to analyze any property in just 15 minutes. We'll start by sharing the exact 23-step checklist we use when looking for properties. And once you know the free tools you can start using today, by the end, you'll know exactly how to avoid a $96,000 mistake.
Now, I saw a story about a Wellington investor the other day. I mean, he's a great guy, a guy called Matt Ryan, right? He bought a property for $603,000, did a $100,000 renovation job, looked like a pretty good quality job, actually. Tried to sell it for $799,000, but ultimately couldn't sell it. Dropped the price to $699,000, so he'd be losing money at that point. Still can't sell it. Now, this guy owns about 100 properties, right? So he's going to be fine.
He's okay.
But the reason I bring up this example is not to say that he's an idiot, right? Because he's not, but just to say that even professional investors can make what feels like a $100,000 mistake, which is really why you need to be able to understand how to analyze investment properties.
And that's why I'm going to show you the exact process that I go through if I'm going to analyze an investment property and figure out, is it suitable or not suitable, all in 15 minutes. Now, we're going to use some of the free tools that are available to anyone, so Area Analyzer and Opes Plus. And I'm going to walk you through our 23-step pre-investment checklist. And bear in mind, I've got a team of 6 people that do this as a job for our team. They go out there and they look at good investments. And what I want to do is give you the same type of criteria that they use or that we use when we're analyzing a property, so that if you aren't doing it yourself, you can do this with any property.
And because this is going to be in 15 minutes, we are going to speed through some of this criteria. If you want to get your copy of all of the 23 steps we're talking about, I'm going to drop a link down in the description. You can just go ahead and download that. But first, walk me through a property you recently looked at, and then after we go through the details, you're going to reveal whether you actually said yes or no to this one.
Yeah, okay. So let's use a property from a developer in Birkenhead. Now, this development project is someone who we know the developer, we've worked with them before, had some good successful projects there. It's a boutique development in Auckland, so I think that's probably a big tick for a lot of people that want to invest in Auckland.
You property people love to say boutique when you really just mean there's
Small.
4 to 6 units. It's a smaller development.
Yeah, which because otherwise, you might be talking about a development of 100, right? And they can be great as well. But I think for a lot of people, particularly in Auckland at the moment, you want smaller developments a lot of the time. The units themselves, really good sizes, 140 square meters. So far, good location, good developer, good size development, 3-bed, 2-bath and garages. And the units themselves, they were well designed. They had an extra high stud. They had a gable roof. The kind of the stuff that's unnecessary from an investment standpoint, but they're nice to haves. Now, the first thing I look at isn't what the property looks like, because I don't care about that. I look at the numbers. So the first 3 things in the checklist are strong historical capital growth rate for this particular area. So let's chuck in Birkenhead. So when I go to Birkenhead, the historic capital growth is 6%. Okay, and now bear in mind, anytime you're looking at Auckland's long-term capital growth, you've basically just lost 1% on the long-term average because we had a big drop there. So because of the time that we're looking at it, i.e. right now after a drop, it's lower than what you would expect. So that is higher than maybe it seems. And then in terms of the region, so Auckland, where is it in its property cycle? So right now in Auckland, highly undervalued. So I think there's some opportunity there compared to other areas like Invercargill, where you're overvalued at the moment. So good, strong long-term growth, a good time in the property cycle. And the other thing kind of I think about is, well, what's the population in that particular area? So come on, Auckland's what, 1/3 of the population?
Well, it's currently 1/3 of the population. It's expected to grow up to over 2 million people by about, I think, early 2030s. In about 7 years' time, it's expected that Auckland's population will creep over that 2 million mark. That's like if everybody in Hamilton picked up and moved to Auckland in the next 7 years.
Yeah, and so I'm talking about the big numbers at the moment, not the cash flow numbers from week to week. I'm talking about the stuff that makes this fundamentally a good investment for the future.
So if those are the first 3 steps in your 23-step checklist, capital growth, is the region overvalued or undervalued? Is the region increasing in terms of the population? Well, did you recommend it to investors or not?
So the numbers were good, but no, we didn't. Now, there were a few problems, and this is where you got to be really careful to look at an investment based on all of the factors. Now, you're not necessarily going to get a perfect tick for all of the factors, but there were some things here that fundamentally I weren't happy with. So going back to that 23-step process, thinking about some of the other factors, when we look at the outlook from this property, the way it was positioned was it looked directly into Birkenhead Cemetery. Now,
yeah, it's looking out your window at the cemetery right there, eh?
Yeah, dead centre of Birkenhead right there.
Well, I mean, at least the neighbours will be quiet.
He didn't even laugh at that. Dead centre of Birkenhead right there.
Well, I got it, but I was thinking about my own joke.
And look, I've done the data on properties at neighbour cemeteries, and there isn't anything to suggest that it's going to get a lesser capital growth rate, i.e. it will double in value at a slower rate, but it is a consideration. And again, this is just one thing that I'm like, okay, that's kind of tipped the scales a little bit. Now, for this particular product, the developer wanted quite a hefty price, right? So now I know that's going to throw up my numbers from a cash flow perspective, and now all of a sudden there's a couple of things that are maybe not as good.
Well, buying a house next to a cemetery is fine if you get a great price on it, right? Like I always think, well, if I can buy it cheaper next to a cemetery, what do I care? Yeah, I don't care if it's next to a cemetery. Oh, I think how lovely, very quiet neighbours. Go visit grandma all the time. But if you're expecting to pay the same price for a house next to a cemetery as one that is not next to a cemetery, then I think you're dreaming.
Another kind of issue was that this has a shared driveway, quite a long driveway, and the issue with that is you've got other houses that are off there, and you're probably going to be responsible for that, but it's really hard to administer who pays what. You can set up a residents association for your units, but that's not going to cover the other units. And so how do you get money out of those other people? What if something goes wrong? You're going to end up with the bill. So it's kind of...
So there might be a bit of conflict between the other people on the same driveway.
Yeah. And all of a sudden now there's just a few things that I'm like, okay, there's some good stuff here, but there's some stuff that is going to be a bit of a pain in the butt. So when we looked at everything in totality, all of a sudden it wasn't one that we were prepared to recommend. And then one other thing is the size of the bedrooms. So we've got a minimum standard in terms of what we'd expect a bedroom to be in terms of the size, because if it's not at an appropriate size, i.e. 8 square meters, you're going to end up having fewer people want to rent that property and use it as a practical room. It could be a study or it could be a kid's room. But the reality is, the smaller the room, the less likely you are going to be able to rent it out as a 3-bedroom. All of a sudden, it might be 2-bedroom and study, or someone's going to come walk through and they'll see, 3-bedroom, they'll come in, that's too small to put our family, so it doesn't work for us. So you've limited your tenant pool for those 3-bedroom houses. And so I just think when we looked at everything on balance, we said, there's some good, but there's some stuff that's going to be a bit of a pain. Overall, on balance, that wasn't one we're prepared to recommend.
And I suppose one of these on their own might be manageable, right? But you add it all up and you think, actually, this isn't going to work. And so the practical things that you can do when you are analysing properties at home is check, are the bedrooms at least 8 metres squared? You'd also want to check how much of that space is in the wardrobe, because the wardrobe actually counts as well. That's a little trick that trips some people up, right? The other thing you'd be able to check is like literally just going on Apple Maps and seeing what else is in that area. Again, there could be something like, I'm going to say quote unquote undesirable, like a cemetery there, which on itself is not a bad thing as long as you get the right price. I suppose the other step is running through that checklist and using Area Analyzer to actually get the data, right? And I think this applies both to investors and also owner-occupiers when they're thinking about like, okay, I want to buy a property that's not going to hopefully cause me too many hassles, and eventually I might sell it in 3, 4, 5 years and move to an even bigger property because you're still looking for a property that's going to like protect its long-term value. But I do think that you need to check the cash flow as well. So step 13 is making sure that it's got a healthy and acceptable yield for the amount of capital growth you expect. And also step 20 is to make sure that it's got appropriate expenses so the cash flow works. And the way that I recommend that people do this is by jumping into Opes Plus. Remember, Opes Plus is our app where you can run the numbers on any investment property in the country. And what I've done is I've chucked in a property there. It's in Karori in Wellington. And I've run all of the numbers and I can see, okay, this property's got a gross yield of about 6.5%, 6.6%. It's a yield property. And then it tells me here, okay, that's a green yield because it's above the absolute minimum that I think investors should look at, which is about 4%. I'd always be looking at above 4%. You can also see how the cash flow stacks up. Okay, so if I borrow all of the money for it, might need a small top up at the start, but it's expected to become cash flow positive roughly in about 6 years, depending on how fast the rents increase and what happens with interest rates. And then if I look at the overall property rating, which is I've trained an algorithm to run the numbers on the property and just spit out based on the metrics that I look at, is this a high opportunity, a standard opportunity, or is it a property that really requires some review? This one here would be a high opportunity, though some others might require review. And this is actually a really good example of the property I'm looking at here has a pretty good yield, about 5.3%. But because of the expenses, it would require review because the cash flow is actually pretty terrible. And as I mentioned before, if you want to download the 23-step checklist with all of the tools we're talking about, with all of the links down in the show notes, so you're able to go and download that so you don't have to be furiously taking notes while you're watching this on your treadmill or walking your dog.
And just one thing I do want to point out before, the reason there is 23 steps is because there's quite a lot to consider. And don't for a second think that everything has to be perfect. There's plenty of times where I'll go through a list and then there'll be just some things that are outstanding about that property that I think this is something we have to recommend. I'll give you an example. Wanaka, we'd recently made the comment, Wanaka, not a place we'd invest, as we're recommending some properties in Wanaka. Now, the reason for that is because when you look at the overall market, Wanaka's got a horrendous entry-level price and a horrendous overall yield. If you look at the averages, the particular properties I was looking at, fantastic yield, fantastic purchase price. So I think there's some opportunity there. Similarly, you might look at those Birkenhead properties, and at first glance, I'm like, really sexy properties, really good configuration, i.e. 3 beds with a garage, really good location, Auckland and Birkenhead. I'm all about that. And then when you look at those other factors, I'm like, there's enough here that I think there could be better options out there. And so you do have to make a bit of a judgment call about the things to be okay with and the things that maybe not.
So now you know exactly how to analyze any investment property in just 15 minutes. But knowing how to analyze a property only helps if you're looking in the right places to begin with, which is why you need to watch this next video where I break down the 6 worst places to invest in New Zealand for 2026. Click the video on screen and watch it now.